Hi, I'm Jane Petty with Burke Herbert Bank, the oldest bank in the state of Virginia. In fact, this summer we're celebrating 169 years of serving customers in Northern Virginia. So one of the things we really enjoy is working with people and helping them to manage their money and to be successful. So today we're going to talk a little bit about buying your first home. I know some of you can find that frightening, but it can truly be exhilarating, especially if you're armed with some facts and with some good experience and some good advice. So I have invited John Tomasello here to join us. He's from the bank and leads our mortgage group, and he has offered to share some of his wisdom and advice and tips for all of you out there who are either ready to buy now or perhaps it's just a dream you have to be able to achieve someday. So, John, if you don't mind, let's get started.
Okay, thanks, Jane. Thanks for having me on. We do enjoy helping people buy homes, and we especially like helping first-time buyers get into their first home. Along that line, there's three basic components that we look for as a lender: cash, credit, and qualifying ratios. Cash can be as much as you want to put down, but it also depends on how much the lender requires. It can be as much as 20 or 30%, or it can be as little as 3%. There are actually times when you can get into a loan with no money down. Credit. Credit would be a big thing we look at, because if you have bankruptcies or collections or foreclosures, those can impact your score, not to mention your ability to get a loan. And qualifying for the loan. So as a lender, we base a lot of it on the ratios. We don't typically want your payment to be more than 30% of your gross monthly income.
Oh, very good, John. That's some good information to get us started there. What would you say is the most common question that new buyers are asking?
Typically, the one that's most asked is, how much cash do I need to have? Because there's a myth out there that a customer needs $30,000, $40,000, $50,000 to get into a home. And that's just not true. You can get into a home with as little as 3%. There are actually programs out there that require no money down, like a VA loan. But typically, the average first-time buyer will put down anywhere from 3 to 5%. So to put that in perspective, we've got on our screen typical home where the loan amount is about $350,000, where the price of the home is $350,000, and 3% of that's $10,500. So as you can see, if you take away $10,500 from the $350,000, you would have a loan of $339,500.
So John, what you're saying is the down payment is money that you put up front that comes off the price of the loan, so you finance less of the home.
That's true. And it isn't so much that you could put down 20% and have this enormous lowering of the payment, because every $1,000 that you borrow is only about $4 to $5 worth of payment. So for instance, an extra $50,000 is only $250 more per month. But it's true, the more money you put down, the less you borrow, the lower your payment. So that's where the cash comes from. There are closing costs, which can be anywhere from 3 to 4% as well. But if you work it properly and you prepare yourself, a lot of times we can have the seller pay the closing costs for you.
Wonderful.
So that's the biggest one. Credit, obviously, is the second biggest thing. Do I have to have a 750 credit score in order to get a loan? And of course, that is also a myth. We do loans with credit scores all the way down to 620. It doesn't mean that you're going to get the best rate in the world. They're probably a little bit of an add-on, but you should check your credit regularly. Everybody's entitled to a free credit report every year. And there's a slide on the screen now that shows you how we view your credit. Obviously, your payment history is key to your credit score. the average credit score across the country is about 660. So, if you're at 720, you're probably in the great range. If you're at 620, you've probably got something on there that you maybe didn't know about. And now might be the time to get that resolved rather than waiting until you actually apply or later.
Great. And what would you recommend for somebody who's, say, perhaps ready or thinks they're ready to buy right now?
Well, the very first thing you want to do is speak to a lender, because the lender is going to qualify you based on your income. Again, we want the 30% rule to stick. So if your income is approximately $80,000 a year, then 30% of that would be a payment of about $2,000 a month. But that's just for the mortgage. You're going to have other debts like a car loan or credit card or student loans. And we don't want that ratio to exceed 45% of your gross monthly income. So where that same person might have only needed $80,000 a year to qualify for that $2,000 payment, once we add in the other debts, they actually need a little bit more. So they need $85,000 to keep that ratio around 45%. So on your screen, you can see an example of what we're talking about. This is a different mortgage. This is a $1,200 mortgage. Once you add $800 to that, your total monthly debt is about $2,000. So if you take the $2,000, divide it by 0.45, you'll see that you need about $4,500 a month to qualify with all your debt and a mortgage that includes $1,200 of principal, interest, taxes, and insurance. So that's a starter. But a lender can get you a pre-qualification letter so that you can go to a seller, and it's very much a seller's market right now, and you can say, look, Mr. Seller, I have been pre-approved, pre-qualified for a loan with an institution, and so he's probably going to be more ready to accept your offer than somebody who hasn't been pre-qualified.
Well, that is certainly giving us a lot to think about. I know there's a lot to buying a home, but it sounds like the future's pretty promising if you do some of these things that you're talking about. So what about a person who, like, just maybe they're recently graduated from college or getting their first job, and they aren't in a position to buy today because they don't have that 3% down, but they definitely say that is what they want to do? What would you recommend?
So again, see a lender. You may not be ready to buy for 2 or 3 years, but see a lender, have them pull your credit, make sure there's nothing on there that's inaccurate or erroneous or shouldn't be there, and get it fixed right away, because that can take some time. You might even need to see a lawyer to get it removed. Start a savings plan. 3% may not seem like a lot, but if you're living on a tight budget, it may take you a couple of years just to save the 3% that you need. But some lenders have grants and other programs with second mortgages that you can actually get to help you with the closing costs and the down payments. So on your screen, these are ways that can help you either get a bigger loan or qualify for the one you want. But can you really increase your income? Well, unless you get a new job or a bonus or something like that, that's pretty unlikely. Can you decrease your expenses? You can if you pay off debt or pay some of it down. Can you eliminate any expenses? Well, you might not go to Starbucks as often as you would want, or IHOP in Sunday mornings, but those things add up over time. The one thing I would suggest, though, and a lot of people have this habit, is they run out and they pay off debt. And that's not something that I would advise until the lenders actually looked at your financial situation. Because if you remove a debt from your credit report that you're actually paying on time, it can actually have the reverse effect and lower your scores.
That's really very interesting, John. I think and I hope everybody has learned something here today. Are there any closing thoughts or anything that you think this audience should know?
Yeah. The biggest problem we have when people go out to get a loan and we tell them that it looks very good is they either run out and buy a new car or they buy furniture, and that's the last thing you ever want to do. or they change jobs and maybe they're on commission and now we can't necessarily use that income. So don't make any major changes to your financial picture when you're in the throes of trying to buy your first home.
Very good. So it's CCQ, cash, credit, qualify. Those are the three things we want everybody to remember. And if you need help, go to the bank, go to see your lender. They'll be happy to help. We're in the business of helping you succeed. Thank you, John. Thank you for being with us
Thank you,
today,
Jane.
and good luck, all you future homeowners.